Dear learners, I welcome you all in this series of lecture on financial accounting. So, today we will discuss the accounting principles and standards. So, this is very important aspect of financial accounting. Well friends, when we talk about accounting principles, so accounting principles are nothing but it serve as the rules for accounting for financial transactions and preparing the financial statements. So, we can call it generally accepted accounting principles, that is GAAP, GAAP. So, accounting principles serves as rules for accounting for financial transaction and preparing the financial statements. It means we have to record the business transactions in the books of the accounts, and we have to prepare the financial statements as per the rules and regulations of accounting principles. So, accounting principles are rules and regulations. So, on the basis of these rules and regulations, we have to record the business transactions in the books of the accounts, and then we need to prepare the financial statements. So, accounting principles are also known as generally accepted accounting principles, that is GAAP, GAAP. The next one is, when we talk about accounting principles. So, accounting principles have been bifurcated in two parts, that is accounting concepts and accounting conventions. So, here you might be seeing that there are 10 accounting concepts and there are 4 accounting conventions. So, we will discuss the accounting concepts and accounting conventions one by one. The first one is accounting concepts. First one is money measurement concept, then business entity concept, then going concern concept, then the fourth one is cost concept, the fifth one is dual aspect concept, sixth one is accounting period concept, seventh one is matching concept, and the eighth one is realization concept. Ninth one is objectivity concept, then the 10th one is accrual concept. As far as the accounting conventions are concerned, there are 4 accounting conventions. The first one is disclosure, second one is consistency, third one is conservatism, and the fourth one is materiality. So, well friends, these are the 10 accounting concepts and 4 accounting conventions. So, now we will discuss the accounting concepts and accounting conventions one by one. First, we will discuss accounting concepts. Accounting concepts refers to the basic assumptions, rules and principles which work as the basis of recording of business transaction and preparing the financial statements or preparing the accounts. So, accounting concepts are basically the accounting rules that should be followed while preparing the financial statements. So, well friends, accounting concepts and conventions, there are few differences between accounting concepts and accounting conventions, because until or unless we understand about accounting concepts and conventions, until or unless we are able to make a distinction between these two terminology, that is accounting concepts and convention, probably we will not be able to understand the true meaning of the accounting concepts and conventions, which helps the accountant for preparing the financial statements. So, therefore, the distinctions between these two terminology is very, very important. So, we must understand what actually we mean by accounting concepts and what actually we mean by accounting conventions. Accounting concepts, see, money measurement concept, business entity concept, going concern concept, cost concept, dual aspect concept, accounting period concept, matching concept, and there are other concepts. So, first we will study the money measurement concept. So, well friends, when we talk about money measurement, so it is very simple that any transaction which can easily be measured in terms of money will be recorded in the books of the account. Say for example, if I buy a machine of rupees 5,000, so it can easily be measured that I have bought a machine worth rupees 2 lakh. So, it has its financial implications. So, such transaction can easily be recorded in the books of the account, and such transaction can only be recorded in the books of the account. But on the other hand, if any transaction which cannot be measured in the monetary terms, say for example, honesty of an employee, so that cannot be measured, therefore, such transactions are not recorded in the books of the account. Then the second one is business entity concept. Well friends, when we talk about business entity concept, so business entity concept refers that the owner is separate from its business. It means there are two separate entity, the first one is business and the second one is its owner. So, owner and business both have separate entity. Say for example, if the owner has started a business investing rupees 10 lakh, it means that the owners have given rupees 10 lakh as a loan to the business, and the business will have to repay this amount of rupees 10,000 as a loan to its owner over a period of time. This is what we can call about business entity concept, that as per this concept, business owner and the business both have got separate legal entity. The third one is going concern concept. So, well friends, going as per the going concern concept, you might have studied this going concern concept, that as per this concept, it is assumed that business will remain continue up to indefinite period. It means whenever we start the business, we never see that we are starting the business for a period of 5 years, that we are starting the business for a period of 20 years. We never know about the duration, about the length of the business. Therefore, it is considered that whenever we start any business, this business is started for the indefinite period, until or unless this business is entered into the state of liquidation. So, keeping in view that the business will remain continue up to indefinite period, the transactions are recorded, the activities are taking place, and the business also remains continue up to indefinite period. Then the next one is cost concept. Well friends, as far as the cost concept is concerned, according to the cost concept, the transactions are recorded in the books of the account against its original price. It means against its cost price, the amount which has been paid in order to acquire the asset is recorded. Say for example, if I buy a machine of rupees 5 lakh, so this machine will be recorded in the books of the accounts against rupees 5 lakh. It means that there may be a possibility that after some time the market value of this machine may go up or it may come down, but it is not affected just by going up the price or just by coming down the price. The actual cost of the machine for the business is rupees 5 lakh because the business has acquired the asset against rupees 5 lakh. Therefore, the cost price of the machine for the business is rupees 5 lakh. So, the machine will be recorded in the books of the accounts against rupees 5 lakh only, irrespective of the fact that after some times whether the cost of the machine goes up or the cost of the machine comes down. So, that is not affected. Then the fourth one is dual aspect concept. So, according to the dual aspect concept, any business transaction which has been recorded in the books of the account has its dual aspect, has its dual effect. Say for example, if I have invested rupees 10 lakh in any business, if I have started a business investing rupees 10 lakh, it means that I have given rupees 10 lakh as a loan to the business. It has its dual aspect, it has its dual effect. On the one side, the business has an asset of rupees 10 lakh because the owner of the business has invested rupees 10 lakh in starting a business. It means rupees 10 lakh have come to the business in the form of the cash. So, therefore, the business has an asset worth rupees 10,000, and on the other hand, the business has an obligation equal to rupees 10 lakh also, because over a period of time the business will have to pay rupees 10 lakh to the owner of the business. So, this liability will remain in the books of the account until or unless the amount of rupees 10 lakh is paid to the owner of the business. Now, as per the dual aspect, there is one accounting equation, that is all accounting assets, assets is equal to liabilities plus capital. Liabilities means external liabilities plus capital. So, here in this case, as per the accounting equation, assets is equal to liabilities plus capital. So, assets is rupees 10 lakh because the business has an cash of rupees 10 lakh, and on the other hand liabilities plus capital. So, here the business has capital of rupees 10 lakh. So, here 10 lakh is equal to 10 lakh because there is accounting concept that if any item is going to be debited, the another aspect of this transaction will automatically be credited. Therefore, both the side of the accounts are always matched, always resembles. Then the next transaction, say for example, I have bought goods worth rupees 1 lakh on credit basis from Mr. Anil. So now we see that I have bought goods worth rupees 1 lakh from Anil on credit basis. So here, if I have bought the goods, it means goods, the stock, inventory is coming to the business. So assets will increase by rupees 1 lakh. So here in the left hand side, that is assets are equal to liabilities plus capital. So here the assets are 10 lakh as cash plus rupees 1 lakh as inventory, total 11 lakh. On the other hand, liabilities plus capital. So here we have capital of rupees 10 lakh plus liabilities. So here we didn't make any payment to the supplier, but that supplier has extended the credit facilities to the business. So until or unless we make the payment to the supplier will be recorded in the books of the accounts as creditors. It means we have to make the payment to the supplier after a particular period of time. So here the supplier, that is creditor, worth rupees 1 lakh. So here assets are 11 lakh, liabilities are 11 lakh. Now the third transaction is salary paid, or we can say amount received from debtors. Say for example, now, or we can call it that we have made the payment of the creditor because we had bought the goods on credit basis worth rupees 1 lakh. Now after 1 month we made the payment of rupees 1 lakh to the creditor. So in the asset side, now we have 9 lakh cash balance plus 1 lakh inventory. So total 10 lakh. Here on the other side we have capital rupees 10 lakh plus creditors nil, because earlier the creditors were of rupees 1 lakh because we had bought the goods on credit. Now we had made the payment of rupees 1 lakh to the creditors. So now the amount of creditor is nil because we had creditors equal to rupees 1 lakh. Now we made the payment of rupees 1 lakh. Now there are no more creditors with the business. So therefore again 10 lakh assets, 10 lakh liabilities. Next one is accounting period concept. So according to the accounting period concepts, so the life of the business has been divided into various segment of the business, because if we simply recording the business transactions and if we are not in a position to divide the life of the business into various segments, we will not be able to evaluate the performance of the business. We will not be able to make assessment of the business. Therefore, the life of the business must be divided into the various segments, and this various segment consists of 12 months, and this period of 12 months is known as accounting period. So it is not necessary that this accounting period must be of 12 months. It may be less than 12 months. Say for example, if I took a decision to start the business from 1st of October and if I am closing the books of the accounts on 31st December, so it means the first accounting period will be of 3 months, and then again from January to December, then the accounting period will be of 12 months. So therefore, in order to make the assessment of the business, in order to evaluate the performance of the business, the life of the business must be divided into the various segment of the business, so that after that particular period, after that particular segment, we must stop for a while and we must look back how things are being performed, how is business doing. So, that way we can easily evaluate the performance of the business. Then the next one is matching concept. So, according to this concept, in order to know the amount of profit or loss, we must match the expenses, or we must match the incomes of a particular period of the business with the expenses of the same period, because until or unless we match the expenses and incomes of a business of that particular period, we will not be able to know that how much profit has taken place or how much loss has taken place. So, therefore, in order to know the exact position of the profit or loss, it is necessary that the expenses must be matched with the revenue of the business of that particular period. Then the next one is realization concept. Well friends, according to the realization concept, the realization concept is very important in accounting terminologies, because say for example, sometimes what happens that when you place an order to any organization, so any income is realized not only at the time of receiving the money from the concerned party. Say for example, if you receive an order of manufacturing 1000 chairs, you manufactured, you employed the labor and you manufactured 1000 chairs of that particular specification. So, here once you have fulfilled your obligations, so the revenue is realized at that particular times when the other party becomes legally liable to pay for that. It is completely immaterial when the payment is made by the concerned party. Say for example, you receive the order that you manufacture 1000 chairs of this size, of this quality, of this color. So, whatever specifications were given by the person who wants 1000 chair. So, if you manufacture those 1000 chairs strictly as per the specification given by the customers, so now the customer becomes legally liable to pay for that. You manufactured the 1000 chairs and delivered it to the customer. So, it does not make any difference that whether the payment is made by the customer today or after some times, because you fulfill your promise, you manufactured and deliver it to the customer. Now, the customer is under the obligation, now the customer is accountable to make the payment. So, at this particular point of time, the revenue is realized. Or simply if you receive an order from any customer of manufacturing 1000 chairs, so at this time also the revenue is not realized. So, you must understand that revenue is realized in the accounting terminology only when you fulfill your promise and the other party becomes legally liable to pay for that. Then the objectivity. Yes, in accounting concept there must be some objectivity, and objectivity must be based on certain proofs. So, when we talk about any recording of business transaction in the books of the accounts, so when we record any business transaction, so this business transaction must be recorded in the books of the accounts on the basis of certain proofs, on the basis of certain evidence. So, this is what we can call objectivity concepts of accounting, because until or unless the evidence are attached to the transaction, there may be the absence of objectivities. Somebody may call it that yes, this transaction is maximum of rupees, this asset is maximum of rupees 1 lakh. Say for example, if I buy a computer and when I record it in the books of the account, then I will have to produce, and I will have to produce the evidences, I will have to produce the vouchers, I will have to produce the evidences that yes, I bought this computer against rupees 1 lakh. Otherwise, someone will say that yes, the value of this computer is of 20,000, some person will say that it is of 30,000, someone will say it is of 10,000. So, in order to bring objectivity in the transactions, we must attach the proof, we must attach the evidence in order to bring objectivity in the business transaction. Then accrual concept. So, this we have discussed that as per the accrual concept, it is not necessary when the payment is made or when the payment is received. So, at any point of time, say for example, if I bought goods worth rupees 20 lakh on 1st of October. So, this transaction will be recorded in the books of the accounts today on 1st of October 2019, and it will be considered the transaction of the year 2019-2020. It does not make any difference whether I make the payment of rupees 20 lakh after 31st March, because the year the financial year starts from 1st of April and comes to an end on 31st March. So, if I purchase goods worth rupees 20 lakh on 1st of October, so it means this transaction will be recorded in the books of the accounts today in this particular financial year, whether the payment of rupees 20 lakh is made after 31st of March. So, making the payment and receiving the payment does not matter. So, as per the accrual concept of the accounting, we must see that when the transaction is taking place. So, the time of taking place of the transaction is very crucial for recording the business transactions in the books of the accounts. So, this is all about the accounting concepts. Then accounting conventions. So, accounting conventions are guidelines used to help companies determine how to record business transactions. So, accounting concepts guide the accountant in order to record the business transactions. So, accounting conventions can also be called as the practice of recording the business transaction. Accounting conventions were established with a motive to bring uniformity in the books of the accounts at the time of preparing them. So, there are 4 accounting conventions. The first one is disclosure. So, according to the disclosure accounting convention, the business is supposed to disclose each and every transactions thoroughly. It means the business should not conceal any facts that can influence the decision of the different users, decision of the various stakeholders, because if we will not disclose the facts of the business transaction, the various stakeholders will not be able to take a right decision. So, there must be a full disclosure, there must be full transparency as far as the business transaction recording is considered. Then the second one is consistency. So, as per the consistency convention, there must be consistency in recording the business transaction. There must be consistency in following the accounting principles. It means that whatever policies, whatever practice the business adopted once. So, this sort of practice must be consistent over a period of times. It means that we should not change the practice or policies very frequently. It does not mean that we cannot change the policies and the practices. We can change, but for that there must be reasonable reason to change the policy and to change the practice. Then the third one is conservatism. So, according to the conservatism convention, we must provide for future losses, not for the future profit. It means we must anticipate for future losses, not for the future profit, because if we will anticipate for future profit, and if future profits are not turned out, so it will impose a question mark, and the financial statements and the integrity of the financial statements will be questionable. Therefore, in order to play the game safe, we must anticipate and we must provide for the future losses, not for the future profit. Then the materiality. According to this convention, the transactions which are of material in nature must be supported by the evidence, because there are many transactions which are not of material in nature. So, if we provide all sort of evidences for those transactions which are not at all material for the business, so it will unnecessarily overburden the accountant work, and it will simply waste the time of the accountant, and the accountant will not be in a position to spend his time for the productivity of the business. So, this was all about the accounting conventions. Thank you very much.